I'd like to welcome everyone here tonight. Thank you for joining us. It's always a pleasure to see so many of our clients take the time to come join us for this evening. So thank you for doing that. Let me share with you my objectives for the next 10 minutes that I have you. There are three important changes at Baskin Wealth Management that I wanted to bring to your attention. We'll go through them. It basically talks to the way we interact with you as a client, and it involves our service delivery, our portfolio management team, and also financial planning, which is brand new to us. In addition, I'll be discussing an important change that we've made to your portfolios recently with respect to asset allocation. As you know, at Baskin Wealth Management, our goal is to provide our clients with customized wealth management solutions and a superior client service experience. In order to continue doing this at that level, to meet and exceed our clients' expectations, we made these three significant changes. The first is to our staffing model. Rob had touched on this. This is critical to how we deliver services to you. This will improve our service delivery to you, and it will also improve and provide better support to our portfolio managers. Each portfolio manager now has a dedicated portfolio associate. The portfolio associate will be responsible and the primary contact for many of the day-to-day administrative client requests that come through. The portfolio manager will still be your primary contact for any portfolio-related or market-related discussions that you want to have. The portfolio manager will continue to be responsible for meeting with the client, for preparing the investment plan, for assessing and adjusting the asset allocation, for managing the liquidity, for monitoring and rebalancing the portfolios, and for implementing any calls to action from the investment committee meetings that we have. As Rob said, if you haven't already met your portfolio associate, we'll try our best to make that happen either tonight or over the coming weeks. Secondly, we're adding to our portfolio management team. David had mentioned two new promotions that we've had. We're very pleased that recently we had the applications for registration for both Ernest and Ben approved by our regulators. So Ben is our newest portfolio manager and added to that team in that capacity, and Ernest is an associate portfolio manager. Both of them are CFA charter holders. Both of them are on our investment committee, and both will be speaking here this evening. Thirdly, we're formalizing our approach to financial planning. We have always taken the approach with our clients to take a holistic view. Our conversations, our discussions will cover a wide range of topics that are beyond just portfolio management and really impact the way we manage your money. The conversations will remain the same, but for those who require it, the process will be enhanced, more formalized, and will involve the use of planning tools and software. The result will be a more comprehensive and consistent experience for our clients in the areas of retirement planning and readiness, as well as general tax and estate matters. Now, Ben, who is also a certified financial planner, will be speaking more about financial planning later this evening. So we talk a lot about the value of customized portfolios. Even though we are embarking on a journey where we're investigating pool funds that will serve a purpose in our firm, we still truly believe that customized portfolios are at the heart of what we do for you. If you look at the graphic in your book on page 3, there's a number of items here that we discuss with you to really give us a better understanding of you as a client. They involve your goals and your objectives, your time horizons, your risk tolerances, as well as a financial planning discussion. These may change over time, so we revisit this every year. It's also important to note that we will work with your accountant and your lawyer to cover such areas as tax planning, wills, powers of attorney, as well as corporate structures. Now, an understanding of our client allows for better decision-making when it comes to the construction of the portfolio. Once the portfolio is built, it is actively monitored, reviewed, and rebalanced as necessary, including adjustments to asset allocation. And this leads me to the last change that I wish to speak with you today. The asset allocation decision is one of the most important decisions portfolio managers will make. This decision can actually be more important in achieving your investment goals than the underlying specific investments selected. The objective is to optimize the mix of investments in different asset classes to maximize the return while reducing or minimizing the potential risk. The key here is asset allocation is based on unique individual characteristics of the client. This is why customization is so important. At Baskin, we have 7 different asset allocation categories. For the purposes of this discussion, we're going to look at the long-term growth strategy, which many of you have. And we're going to focus just on the allocation to equities. For a long-term growth portfolio, the maximum allowed equity component's 85%, the minimum is 71%. Over the past 5 years, for most of our clients, but not all, our investment committee has intentionally allowed the equity allocation to be at the top end of the range of a client strategy. In the case of a long-term growth portfolio, that would be 85%. And you can see that on the graph on page 4. This decision proved advantageous over the time period as it produced overall improved returns, the result of strong equity markets, but especially those in the U.S. Also, we were in the middle of a very low interest rate environment and low returns for fixed income. This is illustrated on the graph on page 5. You'll see the top line, which is in yellow, represents the U.S. market, which has clearly outperformed over the last 3 years, especially. So in response to a changing economic environment, including rising interest rates and higher equity valuations, we are now engaged in a firm-wide program to adjust asset allocation for most clients, reducing the equity weighting and increasing the allocation to fixed income. We're doing this to provide client portfolios with additional downside protection. This will result in the equity allocation moving from the top portion of the range to the lower portion of the strategy range. Again, we'll see this on the graph in the bottom of page 5. In the example of long-term growth, we're now showing it at an equity allocation of 75%. To be clear, we're not looking to change categories for our client portfolios. That decision would be based on changes to a client's individual circumstances. We're simply altering the balance from the upper to the lower portions. We understand that this rebalance may give up some potential upside in the event of future strong equity markets, but we believe it will protect better our capital in the event of future negative equity markets. So if you turn to page 6, there's an illustration here of what the potential impact is on this change. There are 3 graphs, 3 scenarios. We're going to focus on the tan line, which is an 85% equity portfolio, and the middle line or bar, which is blue, 75% equity allocation. In the first scenario of strong equity markets and modest fixed income markets, the reduction of equities from 85 to 75% costs the portfolio only 0.6% in return. In the middle scenario, where we have flat equity returns and better fixed income returns, and that same reduction in equities, the increase to the portfolio is modest. But in that third scenario, where we have negative equity markets and stronger fixed income returns, a reduction in equity allocation from the 85 to 75% increases the portfolio's overall return or decreases the losses by a full 2%. This is significant. We design our portfolios to achieve our clients' goals and objectives. We aim to achieve strong returns, but also to protect capital by outperforming in poor markets. We do not believe in market timing, as you know, and we do not know when this current bull market is going to end. However, we do believe that after several years of a higher allocation to equities, which has been beneficial to our clients, it is prudent to now rebalance and to reduce equities and thereby reducing the overall risk to the portfolios.